More blowups are imminent. I'm your host, Steve Van Metre, and thanks for joining me today. And JP Morgan is warning investors that banks will get crushed as a massive amount of leverage is about to unwind. So over to Bloomberg, where we picked today's story up, as Jamie Dimon says, expect other surprises from choppy markets after UK pensions nearly imploded. JP Morgan Chase CEO Jamie Dimon says investors should expect more blowups after a crash in UK government bonds last month nearly caused the collapse of hundreds of that country's pension funds. Now, what most people don't understand is why this actually happened. Now, when we look at the pension industry as a whole, they're required to buy bonds, and in many cases, they're required to buy government bonds. So in this case, if you're a pension fund, you need to generate yield. But in a low interest rate market, yield is hard to get. So what you find is these pension funds are taking leverage that if interest rates were to continue to fall, that they would get a larger payout. The problem is when interest rates rise, particularly quickly, all that leverage unwinds. What JP Morgan is saying is this is just beginning of what is about to happen. I was surprised to see how much leverage there was in some of those pension plans. I myself am surprised that Jamie Dimon didn't know. My experience in life has been when you have these things like we're going through today, there are going to be other surprises. And he's absolutely right about this. There is a massive amount of leverage that gets built up in the system. So when you have a long-standing bull market that is supported in particular by a central bank that is perpetually lowering or keeping rates artificially low, what happens is leverage inside the system builds up. You see this with investors. They borrow on margin and take leverage long positions on the market, and then when stocks go down, those margin positions get blown up along with their leveraged positions. You see that in pension funds. You see that in the real estate market during the great financial crisis. You see it build and build and build, and that's why these central bank tightening cycles always tend to now end up in disaster because we have really long expansions followed by very aggressive central bank tightening. The upshot, he says, is leverage that has been hiding in unexpected places like UK pension funds will continue to unwind. That, to me, is not an upshot. Someone is going to be offsides, he says. We don't see anything that looks systemic, but there's leverage in certain credit portfolios. There's leverage in certain companies. And you're probably going to see some of that. Now, mind you, this is the same thing we're hearing from the CEO of a bank that back during the great financial crisis engineered all of those products. Remember those credit default swaps that everyone says were benign and really didn't matter. Of course, we know at the heart of all this leverage, who is a manufacturer and seller of this financial leverage? It's always the banks. And here you can see that Jamie Dimon is acting like, hey, there's no big deal. But what do you think? Do you think he's wrong? Do you think this whole thing's going to blow up in their face? Or do you think that all this leverage is somehow just going to slide right through without any disastrous things happening? JP Morgan president, he also agrees, says a recession may be the price to pay to beat inflation, and the market bottom is not in, not even close. After unleashing trillions of dollars in support of households and businesses in 2020, the Federal Reserve is grappling with inflation at 4-decade highs by raising rates and pulling back on its debt-buying programs. The moves have cratered stocks and bonds this year and rippled around the world as a surging dollar complicates other nations' own battles with inflation. I think putting inflation back in the box, he says, is very important. If it causes a slightly deeper recession for a period of time, that is the price we have to pay. And we can look back in history, we can note that usually a recession is the best way to deal with inflation. And the simple answer is this. When you put people on the unemployment line, their incomes go down. And when their incomes go down, they tend to spend less. The problem we'll have at this time around when we have a recession, what the Fed doesn't want to see is, of course, too many people get on the unemployment line, because what happens when you have a financial system that has a record amount of debt? You put people on the unemployment line, they'll stop paying on their debt, and that's how the banks start to get crushed. We talked about this with the used car market in particular, how that's likely to hit small and mid-sized community banks. Well, we'll see if JP Morgan could get around this, but I don't think they can. And here we can note that the bottom is absolutely not in. Here we can see the federal funds rate against the Wilshire 5000 or total U.S. stock market in red. And we can note the stock market tends to not bottom until the Fed is either at the lowest rate of its cutting cycle or already there. And in this case, we note that the Fed is still in hiking mode and not even close to cutting. And also on top of that, JP Morgan mentions that earnings are not bottomed out yet, not a chance either. In this chart, we look at corporate profits after tax in blue and against the monetary base or the Fed's balance sheet in red, both on a year-over-year rate of change. And we note that the Fed's balance sheet leaves corporate profits lower. And if indeed something interesting happens here where the Treasury does institute a buyback program and that starts to drain that overnight reverse repo that we talked about in the show the other day, that comes off the Fed's balance sheet. And if that correlation holds true, well, the economy, particularly corporate profits and earnings, are headed much lower. But that's not the only thing that's headed lower. B of A notes that the job market is about to get ugly. The U.S. economy will soon start to losing 175,000 jobs a month, according to Bank of America. As pressure from the Fed's war on inflation builds, non-farm payrolls will begin shrinking early next year, translating to a loss of about 175,000 jobs a month during the first quarter. The premise is a harder landing rather than a softer one, and notably the issue again is if we start to see such large job losses, again, they're going to happen at a point where we have a record amount of debt. That's how the banks don't escape. At least that's my thoughts. In a perfect world, the Fed would slow the jobs market enough to get inflation back to healthy levels, but not so much it causes significant and persistent job losses. Bank of America, nor does Steve, think the Fed will be able to pull that off. We're looking for a recession to begin in the first half of the year. In fact, arguably, we're already starting to see early signs of it. The job market hasn't figured it out, but I think that's coming much sooner than people think. Some forecasters are more bullish on the state of the jobs market. The Conference Board said recently the Employment Trend Index, a combination of leading job market indicators, ticked up. The Conference Board said this signal that employment will continue to grow over the coming months, although job gains are likely to decelerate from their recent pace, and how quickly this will change. Because Americans' consumer sentiment slumps as current conditions crash to 18-month lows, according to the Conference Board. After an unexpected rebound last 2 months, analysts expected the Conference Board's headline sentiment index to weaken in October, and it did considerably. The headline print fell from 107.8 to 102.5. The drop was driven by a plunge in current conditions, which fell from 150.2 to 138.9, while future expectations also slipped, headed down to 78.1. So what we're seeing now in Conference Board's own data is consumers are less confident. And how does that translate back to the broader economy? Well, if consumers are less confident, what do? They spend less. And if they spend less, that means wholesalers and retailers start to see their inventories build. As their inventories build, what do? They cut back on new orders. As new orders get cut back, well, what do manufacturers do? Lay off people. What does that then turn into? Less consumer confidence. And you start to see the cycle becomes self-fulfilling upon itself until, what is the key point? All that inventory comes back down. But you'll see as confidence plummets, unemployment is likely to head much higher. That is the biggest monthly drop in current conditions since December of 2021, dragging to the weakest since April of 2021. Given the gloomy signals from the University of Michigan, there's more pain to come for the Conference Board. Here you can see in this chart provided by Zero Hedge, we note the University of Michigan survey is showing consumer confidence at multi-decade lows, while the Conference Board, possibly interviewing people that are happier, shows it much higher. But if history is a gauge, the Conference Board's data is about to come plummeting lower. And here we can see when we overlay the University of Michigan's data, because we have access to that in the Federal Reserve database, we note that consumer sentiment plays a huge role in employment because we're going to overlay that against the 4-week moving average of initial claims. So we can note in previous times when consumer confidence shown in red collapsed, there is usually an increase in initial unemployment claims, and that tends to happen virtually every time. Now, right now, we haven't seen a marked markedly move higher in unemployment claims, but likely that is about to start happening pretty soon. And the reason we can make that case, as we talked about, is one of the key points here is what's going on with inventories, and we got that data today. And here you can see retail inventories only down 0.1%, but wholesale inventories on a preliminary basis up a whopping 0.8%. So this inventory build is going to continue to weigh onto the system. The question is how much leverage is in there too? We don't know, but if the banks think they can escape this without getting crushed, well, I think they're the ones who are in denial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.